SOFI stock hit yet again a new all-time low, falling to $6.25 per share, then proceeded to rally from the bottom, currently up almost 2%. Now, it looks like SOFI stock is getting very close to hitting a bottom, and I will provide you guys the context of why I am making that conclusion. Anything can happen. I am not a financial advisor, but this is typical of what you see when you're getting close to a bottom. So we're going to make that make sense throughout this video. If it made zero sense to you guys, hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section, and like the video and subscribe to the channel because it is free 99. And if you have not done that already and you watch these videos, what are you waiting for? Thank you guys for doing that. Now let's get to it. All right, so when we are thinking about SOFI stock hitting a bottom, it really has nothing to do with SOFI stock directly. It has to do with the broad markets. And I want you guys to think back to March of 2020. If you guys were invested in the markets, you know exactly what I'm talking about. But everything got destroyed during the crash of 2020. I mean everything. There was like nothing that did not get destroyed during the height of the fear of the 2020 crash. So everything got destroyed, and then the markets were easily able to bounce from those levels. Pretty much everything went down, everything went back up. Well, what you have seen now is a lot of your stocks, the first ones that got hit are the high multiple unprofitable stocks, which SOFI falls in the category of unprofitable, not necessarily a super high multiple, but unprofitable. So all of those stocks that have been losing money are down substantially, whereas a lot of your safety stocks like Tesla, Apple, Microsoft, Google, Amazon have really held up, if not went up in value over the same time period. A lot of these non-profitable stocks have been falling through the floor, hitting new almost daily all-time lows. So what we need to see happen is the safety stocks, those stocks that I just mentioned, the largest stocks where people are just hiding money out in, need to come down. And we're actually seeing the first signs of getting a little bottom here for a lot of these unprofitable stocks. Why? Well, because look at Apple. It's down almost 1% today. Look at the broad indexes. The S&P down 0.5%. Dow Jones down 0.25%. But a lot of these stocks that are considered to be more of your safety stocks, like an Apple, like an Amazon, like a Tesla, like a Google, are actually down more than the indexes today. So you need to see that safe money get flushed out of the markets. They need to come down, maybe not quite as far down as these unprofitable stocks. Like I wouldn't imagine Apple would fall 60% from here. Even if I'm bearish on Apple here for 2022, I don't think it'll fall 60%. It won't align with the non-profitable stocks. But once they come down dramatically, that's where the whole market can start to get a bid and actually find a bottom and then come back up. Now, I think specifically a lot of your non-profitable stocks, as we do head closer to a recession, will actually do better, because believe it or not, when the economy slows down, when a recession is coming, or at least perceived to be coming, a lot of investors will pay a higher multiple to get companies that are growing 30, 40, 50%, something like a SOFI. So that could be part and part why some of these non-profitable high growth stocks are rallying today. You are seeing a little bit of those recession fears that are starting to kick in, and China did announce a lot of new lockdowns for the day. I believe they're locking down 12 new districts in China, and that is what really caused the markets to sell off initially today. You can see Shanghai was down 5% last night. Nikkei down 2%, HSI down almost 4%, ASX 200 down 1.57%, and Kospi down 1.76%. But take a look, Shanghai down 5%. That's what it is. And even oil fell dramatically. I mean, oil's down almost 5% today. Brent crude is down 5%. Natural gas up 1.7%. So you're seeing a lot of instability due to China today. And that, you know, it's kind of leading to fears of a recession coming even more, and that's why you're seeing some of these higher multiple stocks, non-profitable stocks, that are actually going up today. Well, throughout the rest of this week, we have a lot of earnings. Tomorrow in after hours, you got Microsoft and you got Google. Those guys, I think, will do decent just because they're not going to be hit as hard due to inflationary pressures, right? They might see like wage price inflation, but that's more easily managed, we'll just call it that, than your actual material costs going up. shipping costs going up, something like Amazon and Apple, and your wage price inflation going up. So I don't really expect anything too crazy from Microsoft or Google. You could definitely see a clapping at these companies. They all have high multiples. And then on Thursday and after hours, you have Amazon and Apple. And that's where I'm a little bit more concerned for Thursday. And then you also do have GDP numbers quarter over quarter for Q1 that comes out at 8:30 in the morning as well on Thursday before Apple or Amazon report in after hours. So if all of that is bad, if we finally get a clapping of these large safety stocks, that's really where you could see a bottom. Until that happens, you're simply not going to see a bottom in the markets. I personally think it's going to be pretty hard. I think the bar is set pretty high for a lot of these, large companies, the ones that are over $1 trillion market cap. And I think it's going to be very hard to exceed that bar and to impress investors and give them a reason to put more capital to work in these higher market cap stocks, because after all, if they cannot prove that they are going to grow in a substantial way in 2022 relative to 2021, it's just not going to happen, right? So I think you are getting very close to a bottom in SOFI stock in the broad markets as well. That's really my thought process behind it. And another reason that points me to negative earnings for Apple and some of these other stocks, you're seeing a lot of calls coming through now, but a majority of the option flows today, specifically on Apple, have been very, very bearish. A lot of put options that have been coming through, and the positive order value is only 41%. You typically don't see that on a stock like Apple. Usually the positive order value for the option activity outweighs the negative option activity. Now let's switch gears and talk about SOFI stock, and let's look at the option activity. So we can see for the day, 8 orders totaling $3.11 million, positive order value of 100%, kind of confirming what I'm saying here. And you're seeing a lot of longer dated option activity, a lot of the $5, $7.50, and $10 calls for January 2024 that are catching a bid, and hedge funds and institutions are loading up on those. So it doesn't look, too incredibly bullish for the short term, but definitely here by 2024, hedge funds, institutions are betting that SOFI will be a lot higher than it currently is. As far as the short interest, that is sitting at 20.69%. Borrowed shares of 4 million for the day, return shares of 3.01 million. So you're still seeing a net positive short percentage today. There's still more shares that are being shorted today rather than being covered today. You are seeing the cost of RMX at 5.84% and the share utilization of 100%, days to cover sitting at 3.73. So I think this does go to show a lot, what is actually going on. A lot of option activity that is going through for SOFI, and you're still seeing a lot of shorting activity. So once the markets do finally bottom and you get that reversal in the broad markets, another reason I think a lot of these higher multiple stocks will do well is because the insanely high short interest that they all pretty much have. Like all of these stocks that are down dramatically from their highs, they're like 20 to 30% short, pretty much across the board. SOFI is no exception there, and that's why I think you will see massive rallies in these specific names. Likely, 10 to 25% positive days when the sentiment does actually change. That is going to be all for this video. As far as technical levels, watch the $5 level. And somebody asked me in the comment section of the last video, why do I say the $5 level? And that is really a psychological support level, right? If you're trading at $6, your next psychological real support level will be about $5 per share. $5 flat, that's going to be a level where you either find support or you don't. That's why I want to watch that level. If we do get a flush out, it's possible SOFI does come down to 5. That could likely be the bottom in my personal opinion. If you do see a flush out, SOFI stock holds up well like it is today, almost up 3%. You could actually see a big move to the upside. Depending how much strength we actually hold through that is going to be the main key. If we do get that big upside move here in the near term future, I don't know when it'll be. I don't know if it'll be tomorrow or weeks from now, but I don't think it'll be like super far from here where these stocks do catch a bid from the bottom. The main level, the resistance level to watch is $9.40 per share. That is the 100-day moving average, and then $10 flat. That's going to be the psychological resistance level. And as you guys can see, why I say psychological resistance and support levels, because look at $10 per share. We bounce off this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 times until we finally got rejected and fell all the way down from 10 to $6.25 today. So $5. Next important level, 100-day moving average at $9.40 per share. That's going to be the important level to the upside. So that is pretty much going to be all for this video. Not too much else to actually add. I think you guys got all the information you need to know. As far as the max pain, if things do turn around by the end of this week, max pain is sitting at $7.50 per share. Again, max pain is where the most amount of option buyers lose the most amount of money. So that is where the market makers make the most amount of money, and they try to keep the stock pinned around this max pain price. So thank you guys for watching. I will see you in the next one.